you have to think about when you buy stocks as if you're a shareholder in the company. At the end of the day, when you own a share, you're a shareholder in the company, so you are actually a part owner of the company. You're an owner of that business. So you have to think like a business. Like the way you think for your own businesses, you have to apply that to the stock which you and the business behind that. Because that is what it represents. It is not a wheel of casino that I bought the stock and I'm expecting to make 10 times or 20 times, I don't know what's going to happen. It's not like that, there's a science behind it. So you have to appreciate the business behind the stock that you have. Dhiren is going to agree with me on this strongly. There are really only two things when you have to look at when you're buying stocks. One is revenue growth. When the top line of a company is growing, you all have businesses. You have periods when your businesses are doing really well. Your turnover is growing year on year. And lastly, the second point is earnings growth. How profitable your business is. These are the only two driving factors. This is all you really need to get down to at the end of it. Fifth point is obviously all of us have acted on a tip at some point in time in our lives. I have. Okay. So we are not immune to it. We are all done it. Like our best friend or somebody who knows someone big in the market, he recommended that you buy the stock and you bought it. Okay, it went up, but the market was on your side. But don't rely on tips. You have to do your own homework. It is important that you do your own homework. If you think it's workable, then you should go ahead and buy that stock. But if it doesn't meet the eye, then it's basically a game of wolf and sheep. The tip came to you because you're at the lowest level of the food chain. People at the top are trying to distribute all the stuff which they have accumulated down to you, and you are left holding the bag at the end of it. Which is why I never rely on tips. Right? And the last part is it's not rocket science, it's actually common sense. It's like you're buying a business, right? So how hard would it be for you to analyze a business? It's very, very easy. You have to just have a broad call of the business, and life is much more easy. Okay. Now, I'm going to spend some time on what do you really look at? Just a broad structure. Okay. I want to build a stock portfolio. What do I really do? So the first and the most important thing is in market. Market people like us, we talk about a top-down approach. So a top-down approach is basically where you get an entire macro perspective. What's happening in the world around you, okay, at the moment, okay. What is happening in our country, right? So you have to get a bigger perspective of what's happening, in the world, in your country. Like for example, if there is a war in Iraq. Okay, Iraq is one of the largest suppliers of crude oil in the world. You know that crude oil prices are going to move up. They're already moving up, and our country imports oil because we will manufacture it. Inherently, you all know that rising crude oil prices is bad for us. Don't forget about the stock market, but it is bad for us. Inflation is going to go up because prices are going to rise. Blah blah blah. You know that story. Once you know that construct, you have to drill down. Okay. So if you assume that, okay, now I have this macro construct, okay, there's a war going on, and I have a clue. This war is going to be long drawn out, and prices, crude prices are going to remain high for a long period of time. So India is going to be in a bad shape. Okay, now if that is the macro construct which I am working with, what do I do next? Now I'm going to drill down to sectors. What kind of sectors will benefit or actually lose from this? When you look at the various sectors which are there in the market, there is oil and gas, there is banking. Okay, there is auto companies, there is cement companies, FMCG companies, pharma companies, so on and so forth. You have to build down the sectors. And it's actually a lot of, if you go on the net and start reading, you will figure out over a period of time, what kind of sectors really do well in a bad market, what kind of sectors do really well in a good market. You have to build down the sectors. And then lastly, once you have finalized your sectors which you like, then you go down to companies in those sectors. Okay, I know that automobile companies are going to do really well in the next 3 years. Okay, now what stocks do I buy here? Do I buy Maruti? Do I buy Bajaj? Do I buy TVS? That comes right at the end. You don't start with a Bajaj Auto and then you try to figure out the entire landscape. That's a completely wrong way to go about it. Go from top to down, it will make your life much easier. Like I said in the previous slide, you have to try to understand the fundamentals of the business, because that is going to be your core building block at the end of the day. Right? So, as much time you would spend, doing research on buying a property, like, oh, I like property in Bangladesh because I think Bangladesh is going to be the next destination. There's a lot of office spaces which are coming up over there. The manufacturing industry is growing in Japan and South, so demand in Bangladesh is going to go up. You do all that kind of research to come to a decision that I'm going to buy a property in Bangladesh, right? Apply the same when your mind stops. Do the same kind of research. It's not that difficult, honestly. Actually, the fifth point, you look at the price compared to peers. As you would do any finance stuff, it takes some time to practice this. It's easy to say that it takes some time, but what I want to really drive across from this particular sentence is that there are various ways to compare companies and how you would value them vis-a-vis each other. Like, why do I want to buy a Bajaj versus a Hero Honda? And you have some parameters, right? Why I like Bajaj versus Hero Honda? One would be that, okay, I like the bikes made by Bajaj. Okay, fine, I like the bikes. Now what else you look at? Then you have to drill down financials. Like market share of Bajaj Auto is higher than Hero Honda, and they've been gaining market share from Hero Honda. So yes, they're doing that. It's confirmed. Then you drill down further. You look at top line. You look at bottom line. Is it better than Hero Honda? And you arrive at a price comparison. These are what the fundamentals are. The sixth point again, demand and supply for a stock, it is very, very important. It's perhaps the most one of the most crucial parameters when you're actually buying a stock or selling a stock. People always say that you should aim to buy low and sell high. It's exactly that. Typically, nobody wants to buy a stock when the markets are crashing, and nobody wants to sell when the markets are just scaling up and making new highs. That's human nature, right? It's herd mentality. You have to try and break that code, and we'll come to that later. But that's what I'm trying to say. That we have to try and understand the demand and supply. Ideally, you should be in a position where you have the supply to give when everybody is demanding your stock. So you have to be one step ahead of the curve. One step ahead of the curve, so to speak. Can we move to this? So once you have figured out that okay, I want to buy stocks, and I figured out that okay, I'm going to do this kind of research. I like let's say 20 companies or 30 companies which I've identified. Now, how do I really build my portfolio? Do I buy 20% of one stock, or do I buy 50% of my entire net worth in one stock and 50% divided into 10 stocks? Do I own 50 stocks, 60 stocks? That's something which always really confuses people. But what I have seen generally, what has happened, I've looked at a lot of demat holding statements of my clients, of my relatives, of my friends. Invariably, at the end of any bull run, or when the bull run is finished, a typical demat account will have at least 50 to 60 stocks. You like a stock, you just keep buying it, keep buying it, keep buying it. You buy A, B, C, 10, you buy it, and before you know it, you have 40, 50 stocks. Because people drive this into your head, you should diversify. If you diversify, you will be able to protect your net worth. I think it's absolutely wrong. It's one of the most inefficient ways of actually protecting your capital. You cannot protect your capital by diversifying too much. What it actually does is it eats into your returns. It makes your returns more sound. So I have a philosophy. This is my personal philosophy, but everybody will have their own personal philosophy at some point in time. I think there should be diversification to a particular extent. In my view, how many stocks are enough? I would say not more than 10 to 12 stocks. You should pick your companies right and back them all the way. That is how you are truly going to make a lot of money. And this is what the greatest investors in the market have done. I know people who have made 40 times on the stock, or 50 times on the stock. And it's not by the virtue of they bought the stock in 1980s and they were sitting on it for 20 years. No, I'm talking about those people. I'm talking about people who are investors, who will be buying from the market and selling in the market. Not by the virtue of buying a stock and sleeping on it for 30 years and then I suddenly made 500 crores on the stock. No. I'm talking about people like us who want to build a portfolio, who want to manage it actively and grow a money. Over there, I think ideally you should try to have concentrated portfolio of 10 to 15 stocks, so it gives you diversification. And at the same time, if you get even 2 or 3 of those stocks really right, it can make phenomenal difference to the amount of money you can make on the overall portfolio. And in fact, your entire network, it makes a phenomenal difference. Like I said, the third point, concentration of a portfolio, it's a double-edged sword. So yeah, while I reiterate that you should have 10 to 12 stocks in a portfolio of 15 stocks, not more than that, it has its flip side. If you're right, you can make a lot of money. If you're wrong on 1 or 2 stocks or 3 stocks, you can really lose a lot of money. So it's a double-edged sword. But as you go along and you keep doing aggregations, you get better. You will know which companies to keep, which companies to cut. And that is a principle which I will follow in point number 4. You have to control your emotions. Never ever be married to a stock. You have never taken Satveras to a stock, so don't marry a stock. What is important is you took a decision to buy a stock based on particular parameters. You have to keep assessing those parameters. It's like a doctor looking at a patient, and he'll keep seeing whether the patient is adjusting to medicine, and he'll keep increasing or decreasing the dosage of medicine. But he's observing the patient all the time to get to the end goal. The end goal is to get the patient, normal. So in the same sense, what you have to do is you have to basically try and control your emotions. By that I mean is that never get married to a stock. You have to keep looking at fundamentals of the company, whether it is doing well as per you expected or not. If it is not doing well, you are making a 20% loss on it, it's still better to get out and not stay with it. A lot of people I have seen always get stuck. यार मैंने ये 100 रुपए में खरीदा, अब इसकी वैल्यू 70 हो गई है, मैं अब नहीं निकालूंगा इसको until it comes back to my cost. That's an absolutely wrong thing. Assess. If you think that things have changed for the company, cut your losses, get out. You will get another company to buy which might give you double the money, and you might ultimately end up making 40-50% for the original money which you invested. Don't stay married to a stock. It has happened to me personally. I tell you, in 2007, when I was at the height of the bull run, the previous run before the entire Lehman bankruptcy, I'm sure a lot of you know about the Lehman chapter in 2008, right? I used to work at Lehman, so I was there on bankruptcy day at Lehman. That's one day which I'll never forget in my life.
He's the person to catch it down.
So, in that year, in January 2008, I had bought a stock called Asian Electronics. I don't know how many of you have ever heard of this company. I'm sure Dhirubhai has. Right? I was, I'd spent 7-8 years in the market, but what the market does to you, it's like an animal. So, you get carried away. Your emotions get the better of you. Somebody gave me a tip. I was working for the top-notch investment bank. I used to do my own research. Somebody gave me a tip, and it came from a very strong source that buy the stock that's going to double in the next 3 months. I did some basic analysis. I thought it's great, and bought it. I bought that stock at $500, and I kept buying it on the way down. Where I sold it ultimately? I sold it at $25. 2 years later. The fundamentals of that company had changed 6 months after I bought the stock, but I was blind to it. And I could have still gotten out at 300. But I kept buying more. Because I wanted to average down, I thought at some point in time, the stock will bounce and I'll be able to get out. You get something wrong, the parameters, fundamentals have changed, get out. And this is why point number 4 is very important. You should have strong control over your emotions. You should know where to cut your losses. That is more important than trying to book profits and letting your winning stocks keep running all the way. The key to this game is trying to control and minimize your losses. You will make money by yourself. The market will take care. So, like I said, if you go back. Yeah. So you'll be wondering what do I mean by this? Remember Abhimanyu study coming in Mahabharata. You know what happened in Mahabharata, right? In Mahabharata there was a Chakravyuh, only Abhimanyu knew how to get it. He knew how to get it, he got it. But he did not know how to get out. And that was his downfall at the end of the day. Remember this thing. It's very easy to get into a stock or get into stock markets or buy, build a portfolio, but how do you really exit? How do you book gains? How do you cut your losses? Cutting your losses, I think, is more important than booking gains. Remember that. It's very, very next slide. So, once I have decided, okay, I'm going to build my portfolio, how do I really go about it? I am not one of those market wizards, where I have a network or I have access to managements and I have inside information. One thing, get it out of your head, that a lot of people make money on insider information.